If you're thinking about investing in the Investor First Fund, there's one question you probably want answered before anything else. Where does the return actually come from? That's a fair question, and it's the right one to ask. So let me walk you through exactly how this fund earns money and how that money becomes the income that shows up in your account every month. Let's start with how the Investor First Fund actually works. The fund owns a collection of real estate loans. These are loans we have made to borrowers here in Texas, secured by residential real estate. So when you invest in the fund, you're not buying a stock or betting on the market. You own a share of a pool of real estate loans, and those loans pay interest every month. That brings me to the first way the fund generates revenue: monthly interest payments. The rates on our underlying loans vary, but for this conversation, let's use 12%. And let's use a sample loan of $1 million. At 12% per year, the borrower pays about 1% of the loan every month. 1% of $1 million is $10,000. So every month on that one loan, the borrower will send $10,000 in interest to the Investor First Fund. That is revenue for the fund. The second way the fund generates revenue is through collecting origination fees. Whenever we close a loan, we charge the borrower an origination fee. That fee runs between 2 and 3% of the loan amount. In our $1 million example, let's use $30,000, earned over the term of the loan. Those are the two sources of revenue: monthly interest and origination fees. Now, what comes out of that revenue? The fund has expenses like any business. We pay a third-party fund administrator every month to handle accounting. We pay an auditor who reviews the fund every year. And we also pay for loan servicing. But the largest payment that leaves the fund by far is the preferred return that goes to you, the investor. Here's how that works. The fund targets a preferred return of 8.5% per year, and that is paid to you monthly. So take that 8.5%, divide it by 12, and each month you receive about 0.7% of your investment. That payment comes to you by ACH directly into your account every month. Let me put some real numbers on it. Say that you're a first-time investor and you come into the fund with $250,000. At 8.5% per year, that's about $21,000 over the course of a year. If you break that down by month, then it comes to about $1,770 every month. And you don't have to do anything to receive it. It arrives by ACH in the middle of each month, whether your investment sits in a cash account or an IRA, at a bank, or with a custodian. Here's another question that we often get. After that 8.5% is paid, what happens to anything that's left over? That's a great question. We call that excess distributable cash, and that is where our company, the manager, Stein Capital Management, earns its fee. Here's the part that matters the most. We don't earn anything until you've been paid your 8.5% first. You have the first priority. Anything above that is the excess, and that is what goes to the manager. You do not participate in the excess because you've already been paid first, whether there is any excess or not. That means that we only earn when the fund performs. Your return comes first, ours comes after. One last piece is how this process continues. When one of those underlying loans pays off, the principal goes back into the fund. In our example, that $1 million loan pays off, and then that money comes back into the fund. Then we redeploy it into a new loan. That new loan creates a new stream of monthly interest and a new origination fee. The revenue comes in, the expenses are paid, your preferred return is paid, and the system repeats itself. So that is how your return is generated. Real loans, real interest payments, paid by real borrowers here in Texas every single month. If you'd like to see the full picture, you can find us at stallioncap.com. We would be glad to walk you through it. Take care.